final presentation, because this afternoon's the panel discussion. The speaker for this session has been a professional trader since 1985. He's worked for numerous investment banks. He runs his own newsletter and advisory service, The Chartist. But I reckon his greatest credential is he was the ex-vice president of the ATAA. Please welcome Nick.
Thank you. Yeah, blah, blah, blah. Get over that. Men stumble over the truth from time to time, but most pick themselves up and hurry off as if nothing has happened. The truth is here. It's not hard for... How do I explain this? Trading, to me anyway, is incredibly simple. And I don't say that from an arrogant perspective. It's just easy. And it can be easy for anybody if they know what to actually do. I'm going to ask a few questions today. Most aren't trick questions, so, don't be shy to answer them. But what I want to come across, or what I want to get across, is successful trading is looking in the right place for the profits. I've been trading since 1985. I am a trend trader. I trade 3 different trend-following systems. I've done it all my life. I'll continue to do it for the rest of my life. And I'm teaching my children, including my 8-year-old, how to do it as well. Now, that's not to say that trend trading is the holy grail. The holy grail is something that is contained within trend trading. It's contained in all parts of trading. And if I can get that across to you today, I think my talk will be successful to help you out. But this is very important. The truth is not what you think it is with successful trading. And that's what I want to try and get across to you today. Please feel free to ask any questions as we go through, okay? I'm quite happy for that to happen. What I want to talk about is the 2 facets of trading: quantitative and qualitative. Quantitative. Let's talk about that. Let's use the analogy of a motor vehicle, driving a car. What are the quantitative parts of driving a car? You put your foot on the accelerator to go forward, turn your indicator to go left, put your foot on the brake to stop, put it into gear to go backwards, turn the wheel to go left, turn the wheel to go right. These are quantitative parts of driving a car. They are teachable. Would you agree? You go and have a driving lesson. Who here has kids that are currently learning how to drive? And that's what... Scary stuff, isn't it? That's what you're doing, right? Stay on the left-hand side of the road, please. Turn left here, not right. This kind of stuff. It's teachable. Now, I pose a question to you. Who here has done an expensive course or seminar on trading? Who's done 2 or 3 expensive courses on trading? What are you doing here again today? Dear me. Yeah. Hold on, here's my wallet here. Those of you that have done these expensive courses, 2 or 3 of them, I had a guy in Brisbane, he'd done a $25,000 course. And I said to him, in front of everyone, I said, "So what are you doing here today?" He goes, "I'm just trying to learn how to trade now." And that's it. You go and do these expensive courses, buy these books, you're going around and around and around and around. But what you're learning is the quantitative part of trading. Those of you who've done an expensive course, did they make you successful? Yep, okay, 1, that's good. Would you think it's possible that you can go and do an expensive course and 3 months down the track you think, this is just not working? You think that's possible? That's happened to you? Because what you've been taught is the quantitative part of trading. You haven't been taught, and I'm not sure that it can be taught, the qualitative part of trading. That's what I'm going to talk about today. If we go back to our motor vehicle or driving our car, can anyone tell me what the qualitative part of driving a car is? Sorry? That's quantitative because you're being told how fast to drive, right? Is this in Australia or is this in America? I mean, different things, mate. Yeah, okay. What about the flow of the traffic? Okay? Understanding the flow of the traffic. Anticipating what, I was going to say the guy in the Volvo next to you is doing, but I better not say that. Anticipating what the other drivers around you are going to do. It's gaining a sense for a dangerous situation. Okay? Michael Schumacher said just recently, the most successful drivers are those that understand what's going on around them. In other words, he's talking about the qualitative part of driving, not the quantitative part. And so it is with trading. We go to all these seminars and these conferences, and we buy all these books. We do all this stuff, and we go around and around trying to become successful. The reason that we're not gaining success most of the time is because we're learning just the quantitative part and not the qualitative part. And that's what I want to talk to you about today. I can't teach you this stuff. So I may as well go. I can just plant the seed in your mind to have a think about it. Because that seed was planted in my mind many, many years ago, I get it now. I understand it. And once you get it, you're away. That's it. And that's what we want to talk about today. So, thinking quantitative and qualitative, what would be some quantitative facets of trading? What have you been listening to this morning? Entry patterns, trailing stops, a trading plan, indicators, stop loss, blah, 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 blah. All the stuff you find in books and go and pay $25,000 for. Okay? That's all the parts of quantitative. Who can think of some qualitative parts of trading? Sorry? Order flow? Psychology. I wasn't here for Louisa's talk the other day. She could have tapped into some of this stuff. Psychology, yes, I agree. Can you teach psychology? I don't think so. So, you know, absolutely, that's part of the qualitative approach to it. I'm going to talk about the Lake Wobbegong effect, apparently. Has anyone heard of this? You have? The Lake Wobbegong, and we'll come back to quantitative, qualitative in a second. The Lake Wobbegong effect is a cognitive bias, and it comes from a radio show in the US that was finished up each day with the words, all women are strong, all children are smart, and all men are good looking. A survey in the US of men suggests 90% thought they were better than average looking. 93% of drivers in the US believe they're better than average drivers. 88% believe they're safer drivers than the average. This is a form of cognitive bias. It means that basically you overestimate your own abilities. You overestimate things. It's impossible for 90% of people to be better drivers than average. 75% of, I think it was Harvard MBAs, thought they were in the top 5%. So this is the whole idea of the Lake Wobbegong effect, is that we overestimate our abilities. But I just want to put a little spin on that. We can overestimate our own ability, but when it comes to trading, we tend to underestimate what's required. In other words, we tend to underestimate the qualitative traits of trading. And once you underestimate that, you're never going to make it a successful trader, or you're going to keep going around in what I call the beginner's cycle. Beginner's cycle is you go and do a course, you follow the rules for 10 trades, you have a few losses, you have a few break-evens, a little win, and you basically think this is crap. And then you go to another course, and the same thing happens. You make 10 trades, nothing's really going on, and you just go around and around. Who here owns more than 10 trading books? Who owns more than 20? Who owns more than 200? That's why they're down there in the far left-hand corner. Why do you have so many books? Cheaper than courses? That's right. Is that you, Dennis? Hello, mate. I haven't seen you for a while. You're down the front row to pick on me today, aren't you? So it's interesting why you think you have to have so many books or you have to attend so many courses. Why? Because really, if you get it, you don't have to, right? And this is what I want to try and get across here, these qualitative traits. If you can start to understand and grasp these qualitative traits, then you will be much closer to being a successful trader. I'm just going to talk about a couple of them here. Time constraints, we really can't go into a lot more, but here's a few that came to mind. Sample significance, losing streaks, risk tolerance, and the work required. We'll talk about all of these individually as we go through. I'm going to show you a few home truths here. Maybe not proud about them, but to get the message across, that's what we've got to do. Let's talk about sample significance. And this is probably my pet hate. People ring me and ask me questions, and this is the one that really pisses me off the most. And this is the one where I think people have to overcome. I'm a trend follower. I trade 3 different systematic trend following methods. I always have, I always will. I believe, personally, just my belief, that if you want the easiest, low-stress way to make money, you just got to be a trend follower. This is a turtle system. I had a lot to do with the turtles in the 90s. I started trading the turtle system in 2001. It's now a part of my service. And this is the equity curve. It's got a 29% annualised return. Win rate is only 48%. Max drawdown 11.5. It's a long-only equity system, this one, okay? And you can see the results go all the way through to October 2009. So there's no monster 2008 collapse there or anything like that. Would you be interested in trading this? Would you want to trade this? It's not a trick question. Okay. I remember doing a talk back in ATA Sydney in about 2000. I did the same kind of things, and I had actual account statements. And I gave the gentleman in the front row the account statement, asked him to read out the balance and the date. It was $50,000 and whatever date. And then I asked him to read out the next one, same account, 6 months later, and the date. The account balance was about $87,000. Real account statements. Who would like to trade the system? Of course, everyone goes, yeah, no problems at all. But it turned out in that particular experience that probably 50% of those who had a hold of the system actually continued to do that. And this is what happens here. Now, most of you have said, yes, you'd like to trade this. So here's an email I get. Just the other day, October the 8th, I got this. All the recommendations and stops were blindly followed. Well, that's the problem right there. the results are not good. 8 closed trades, 4 losses, 4 break even. 4 open trades, not a single win for the month. Don't want to be impolite, but is it a bad period or just setups are just for study, not for trading? Well, I don't know about you, I trade to trade rather than trade for study, but is anyone having the same experience? I noticed your VAMI is heading down. A VAMI is called a Value Added Monthly Index. I show all my subscribers my positions on a daily basis. They get to see what positions I go into and why I go into them. And I also plot my equity curves. So they can see what my accounts are doing. And that's what a VAMI is. And he's going, well, your VAMI is going down. Okay. So, problem is, he's talking about that system I just showed you. He's talking about that. Now, you've all said you wanted to trade that. It's all pretty easy. Yet, that's the kind of email I get occasionally. And remember, we're talking about sample significance here. So he's talking about 12 trades. So what I thought I'd do very simply is I went back to 1997, ran the system. It produced 1,950 trades. And basically, I divided 12 into 1,950, and there's 161 compilations of that. But, I mean, this is very simple. We're just looking at the losing trades up the top there. In other words, if I was to pick 12 trades, random trades, how many in that 12 would be losers? How many would be profitable? And how many would be break even? Okay? So you can see there that there is a chance out of this 161 selection that you can actually have 11 losing trades in any 12. Who'd be happy with that? You'd go, Raj, you are crap. I've just done 12 trades. I've had 11 losses. Give me my money back. That's what you'd say, right? That's what we're trading, and that's what basically it will look like in any given sample. Does everyone understand what I'm saying here? So you could actually have on the winning side, there is or has been a series of 10 winners in a row. Any questions? I'm going to play a little game. Some of you have seen this, so I apologise. This is 1,500 trades. And again, I've just put in the numbers from that turtle system, long-term numbers. And I just want you to tell me, if we think of units of risk, for example, 1 unit of risk and therefore units of profit, I just want you to point out to me which equity curve here you don't want to trade. Okay? Just let me know when we get to one of those. Just tell me. Whenever you're ready, you can tell me which one you don't want to trade. Okay, so you're all happy for this, right? These are the kind of things spookers put out, aren't they? All right. I want you to do the same thing now. This is a random number generator. They're just generating random numbers. The statistics are in here exactly the same as that turtle system. Just tell me which one you don't want. What we're looking at here is 12 trades. You don't want that. No, you don't want that. You understand what's going on here? We're looking at a subset of a bigger sample. And this is what the sample significance I'm talking about. People will take a very small sample of trades and they will make their decision based, now you've done it, based on that very small sample of trades. And so this is what happens. This Michael that sent me this email, I hope he's not here, he has looked at these 12 sample trades, or he's looked at this 12 period of trades, and he's now made up his mind that it's crap, that it won't work. Who here has been in that position where you've bought a course, you've done a few trades, or you've subscribed to a newsletter, you've done a few trades, some of them are losers, and you've thought, not for me. Has anyone done that? Okay. You'll do the same thing with a book. You'll buy a book, you'll follow the rules. You know, you'll buy John's book or Dave's book or something like this, and you'll follow the rules, and you'll have an average period of time, and you'll think, this is crap. It doesn't work. You'll go and buy the next book, and there we finish up with 200 books. So my point is, a small sample of trades is an insignificant amount to determine what happens in the longer term. And I'm going to show you some pretty amazing slides at the end here. Well, I think they're amazing, but I'm a little bit weird when it comes to trading. So that's the first thing, sample significance. Okay? You can't judge your success on 12 trades. Losing streaks. I've been trading for 24 years. I started when I was 18, so I've been doing it more than, half my life. My best run of losing trades in a row is 22. And I've done that twice now. Who here hates losing trades? Okay. It's a function of life. It happens. It's a function of trading. You've got to have them. You don't like having losing streaks in a row. But the probability of having losing streaks can actually be calculated. And this is very interesting, especially after we've heard Howard talk about system testing and everything like that. So I've got a couple of surprise questions for Howard. So that's how we calculate losing streaks, basically. Simply, it's down to your winning percentage. If we use a trading system that has a winning percentage of 50%, over a sample of 50,000 trades, there is a chance that we will have a streak of 16 in a row. This is mathematical fact, okay? This is not back testing. It's a mathematical fact that it will happen at some stage. It might not happen this week. It might not happen next month. It might not happen next year. But it should, if you trade long enough, it should happen. One of my philosophies is that if you trade long enough, everything's going to happen. You'll see things. I started trading in 85, and it's scary to think what I was doing back then. I'll tell you what I was doing back then. I was trading, and don't laugh, I was 18. I was trading a 5 and 10 day moving average crossover system on the SPY futures when it was $100 a tick. That's just crazy. But I had no idea what I was doing. And really, 1987 fixed that up. I learnt then, and it's never happened since. But the other thing I would say is I'm not the world's most profitable trader, and I certainly don't put myself out to be the most profitable trader, but I'll never go out the back door, okay? So I just look for good annualised returns of, 30 or 40%, that's it. I've got mates who make, unbelievable returns, but that's just not me. But these same mates, one of them, he lost 80% in one night. So that's not going to happen to me. But what I do respect is the probability of a losing streak. If we work it out, if we do a little table, you can see that even if you have a win rate of 90%, there's still a chance you can have 5 losing trades in a row. There's a very big education firm, used to be based in Queensland, won't mention names, that recommended that you place 10% of your equity on each trade. Now, by my calculations, they would have to have a win rate of something like 94%. Because the chances are, at some stage, they would have 5 losing trades in a row, and they would lose 50% of the capital. And the problem is, 2 things happen when you lose money, right? No one likes losing money. But more importantly, psychologically, it can be devastating for you. There is nothing worse than not being able to pull the trigger. You've always got to be able to stand up the next day and pull the trigger and do it again the next day. But if you lose a lot of your capital, you're going to find it very, very difficult to do that, and you're going to go back into that beginner's cycle. You're going to go and find something else to do. So keep in mind this little table here. You can see 50% your probable streak will be 16 losing trades in a row. Even at 90%, you can have 5 losing trades in a row. Now, that's a real equity curve. That's a Hang Seng system I developed, and that equity curve starts in 2001. That's real trades. 2001 through till, I think that was mid last year, late last year. That big explosion in the equity curve was because of the volatility in the stock indices around the world. Real trades. Up the top corner is the back testing, the historical back testing. Win percent of 33, win-loss ratio 2.9, losing streak 14. Okay? Down the bottom right-hand corner, they're the real stats. 354 grand net profit. You can see the win percentage there is 34%. It's at 18 losing trades. Here's a question, maybe for Howard. If you go and develop a trading system using AmiBroker or TradeStation or Charles's system that he uses, and you do your back testing and you have 14 losing trades, you think I can deal with that, no problems at all. Real-time trading comes along, and you're at 14 losing trades in a row. At what point do you stop? No, sorry. So the question posed is, if you do your back testing, you've got a robust, you've done your back testing, your forward testing, blah, blah, blah. And it says 14 losing trades. At what point in real-time trading would you stop trading the system?
I'd make a couple of comments, Nick, and they're related to what I said yesterday. And let me start by saying that you and I are not disagreeing. I could have used your slides and you probably could have used mine and be making the same point. Assuming that these results are coming from an out-of-sample test and not an in-sample test, then there's reasonable expectation that the real-time trading follows the out-of-sample results in backtest. And we can compare the real-time trading to the out-of-sample baseline, and we would look for a statistical deviation between the real-time results and the baseline results.
Okay.
Now, if we've got 10 trades in a row where the average of those 10 trades is less than 0 in expectancy or profit, or if the mean to standard deviation ratio of the last 10 trades is less than 1 to 4, we should take the system offline.
Okay. Got it. Everyone get that? So for everyone else out there, when would you stop trading the system? Okay? I mean, it's a real question. You go and do your testing, you have 14 losers in a row, and you have another one, and then you have another one, and you think, ooh, something's gone wrong. The market's changed. The markets don't change. The only change is change itself. Remember our little table up here. The table says, with a winning percentage somewhere between around the 35% mark, we should have somewhere between 25 and 30 losing trades in a row. Okay? So we've got 18, our testing shows 4, we're a little bit nervous. Real-time trading, right? This is a real account. 29. But that's what our formula said would probably happen at some stage. So you could call this a black swan event if you like, but we all know the tails are a lot broader than what's put out there. Same with option trading. You know, you have these people telling you about all these nice little strategies of selling calls and puts and naked shorts and all this kind of stuff. And look, it works for 5 years. And then one day it's all over. Completely all over. So it's just a matter of when, not if. It's a matter of when. And if you trade long enough, these things will happen eventually. So you've got to be prepared for this kind of eventuality. It's not nice, but I'm not glossing over the reality of trading. I'll leave that up to the spruikers. Immediately on from losing streaks is risk tolerance. Okay? We hear a lot about the 2% rule. Don't risk more than 2% of your account. But unfortunately, 2% is not for everybody because everybody has a different risk tolerance. Agree? I get people coming to me saying, Nick, I want to make 25% a year, but I don't want to lose more than 5%. Yeah, right. Can't help you. Here's some facts. The only thing you can control is how much you're willing to lose. Does anyone disagree with that? That is the only thing you can control when it comes to trading. Who thinks I'm a professional trader? I'm not a professional trader. I am a professional manager of bad trades. That's all I do. Just put trades on and manage the crap ones. Because the good ones will look after themselves. So it's my job to look after the bad ones. And that gives me the positive expectancy. It's pretty simple kind of stuff. How much you win when you win and how much you lose when you lose. So the only thing you can control is how much you're willing to lose. Regardless of how good you are, you will have losing streaks. Now, I understand we're going to come across, and there's probably some people in this room that say, oh yeah, but Nick, I've never had more than 3 losing trades in a row. I don't dispute that that happens. That's not my point though. I'm just your average bloke trading. So I'm talking about Joe Average here, who will have losing streaks and bad periods of time. The textbook 2% rule may not be appropriate. True story, last year, on our short-term swing trading, discretionary trading, we made 170 odd trades, we were up about 157%. During that period of time, equity dropped 11%. I got an email saying, thanks Nick, the pain's too much. Okay. Right. So the problem is you should never get to the point where the pain is too much. This particular guy, his account was down 10%, but the pain was too much. And I said, well, what are you doing? He goes, well, I'm doing everything you're telling me to do. I said, what about risk management? What risk are you putting on each trade? He goes, I'm putting on 2%. And I said, well, hold on a sec. The probability of what we're doing here is we're going to have at least 15 losers in a row. You're risking 2% of your account, which is what he read in a textbook, which is normally talked about. So the chances are he was going to, at some stage, have a 30% drawdown. But he was only willing to deal with a 10% drawdown. In other words, he was trading way over his risk. It wasn't the system, it was his risk. It was the fact that he was using 2%. He should have been using about 0.5%, half a percent. That way he'd never get to his risk threshold. The one thing with trading is if you lose all your money, you actually can't trade anymore. So the point is, even if you lose a lot of your money, psychologically, as I said before, you're not going to be able to pull the trigger again. And you never, ever, ever want to get to that position. It doesn't matter how bad the market is. Do you agree? So the 2%, the textbook 2% rule that we're always talked about, is not really appropriate for everybody. The last known fact is the more you risk, the more volatile your account will become. It's simple as that. If you want to go and ride a roller coaster, go to Dreamworld, or go and bet 5 or 10% on each trade. Simple facts. Anyone disagree with any of those? There's probably a few more in there. So if we add on our Lake Wobbegong effect, remember that we overestimate our own ability, my advice is think about the maximum amount of money you are prepared to lose and then halve it. Because according to the Lake Wobbegong effect, you are overestimating your own ability to take a loss. Well, not take a loss, but take an account drawdown. Okay? So if you think you can handle a 30% decline in your account, I would say you can't. Halve it just to be sure, so you never hit that pain threshold. The point I try to make to a lot of people is you have to trade so a loss just doesn't hurt. You don't even think twice about it. Bang, loss, gone, forget it, no problems. If you lie awake at night or you get up early and you run downstairs and find out what the Dow Jones is doing overnight, you're probably trading too much risk. Anyone do that? Wonder what the Dow did last night. So I trade, it's just a loss, it's just a trade, it's just move on. It's no big deal. One of my core philosophies is next 1,000 trades. One trade is not going to make or break me. It's like a professional golfer, right? You think about a professional golfer, he plays 72 holes in a tournament. One shot is not going to win the whole tournament. But one shot can make sure he loses the whole tournament. And it's the same with trading. One bad trade and it can cost you. So whatever you think you can handle, John, you're an ex-Marine. You can do a Jack Nicholson. You can't handle the truth. You can do that. So that's my point. Work required. Any doctors in here? Who's been to a seminar on the weekend? Looked at their screen on Monday and thought, I'm a professional trader today. Go on. You're a doctor. How many years did you go to uni?
6 at uni and about 8 years postgraduate doing other courses.
6 years and then 8 years postgrad. Were you then a doctor?
Oh, so I was a doctor after 6.
You're a doctor after 6.
Not a specialist.
Okay. Why do we think we can go to a weekend seminar and become a professional trader on Monday morning? Because you're paying 25 grand, you should be able to. Here's the S&P 500. This is a good example of, what's that law that you double your money every 7 years or whatever and blah, blah, blah. That's the one, whatever. I'm not good at maths. That's the S&P 500. Okay. Bill Eckhart. Anyone heard of Bill Eckhart? Bill Eckhart, arguably one of the best traders in the world. That's his equity curve. $10,000 to $448,000 after fees. Remember, this guy takes 20% of the profits. So this is net of all his fees. He kind of flatlines the S&P 500 in that time, doesn't it? 25, that's what a 25% annualised return looks like. But what does it really look like? What does it really, really look like? Well, here's his month-to-month data going back to 1987. Most people think a professional trader wins day in, day out, month in, month out, year in, year out. Who wants 25% a year return? Yeah. Who is willing to do the work to get there? That's why we go and do the $25,000 courses, so we don't have to work. The red boxes are all 4 consecutive or more losing months in a row. The blue circles are his end-of-year return. Who would have thought that a guy that returns 25% per annum over the last 20 years would actually have a losing year? You wouldn't think that. And he's got, well, 3 completed and 1 on the way. Who would think that a professional trader that manages a $450 million fund like this could possibly get away with having 5 losing months in a row? Let alone 5 losing trades in a row, 5 losing months in a row. The far right-hand corner down here is his maximum drawdown. So that's equity peak to trough drawdown. Look at his first year, 28.5%. That was his maximum drawdown. And that happened in 2 months. You subscribe to a Chartist or someone like that and you start with a 28% drawdown, what are you going to do? Take me to court. Crikey. So that is Bill Eckhart's trading for 22 years. That, to me, is quite an impressive picture because it actually shows the reality of long-term track record. Now, he does 1,019 round turn trades per year. A round turn is a buy and a sell. So he does 1,000 trades in and out. It's a lot of trades, 20 trades a week, 4 trades a day. Yeah, John. Is that per million or for the entire portfolio? That's per million. Yeah, 1,000 round turns per million. That's a heck of a lot of trading, isn't it? But he's making 25% a year. Now, you all put your hands up. You always told me you wanted to do 25% a year. But would you really be prepared to do all these trades? A lot of people wouldn't. Okay? The turtle system that I run is pretty active. It doesn't do half that amount of trades, but it's still pretty active. And even I get emails going, "You're bloody kidding, aren't you, Nick? I can't change all these orders every day. It'll take me 5 minutes." So that's pretty impressive, isn't it? You'd agree with that? That's pretty good. I get a kick out of that. I've told you a bit weird. All right, Bill Dunn. You guys know about Bill Dunn, wouldn't you? Mm-hmm. Bill Dunn manages about $5 billion. He's a trend follower. He started back in 1973. You know what? He still uses the same system today that he created back in 1973. Compound annualised rate of return after fees is 18.8%. The blue line is his equity curve. Not quite as good as Eckhart's. But have a look at those drawdowns. He's just had a 60% drawdown. Look when he started. The year after he started, no, 2 years after he started, he had a 50% drawdown. Crikey! Imagine investing with him. What are you doing, mate? Pretty amazing when you think about it. He just stands up to the plate again, regardless of what's happening, and does it again. Has a drawdown again. No, does it again. Places the next trade, the next trade. Keeps going. Why? Why can he do that? Why can Eckhart do that? He has 5 losing months in a row. He's down 21%, and he takes the next trade. Why? Confidence. Where does he get that confidence from? Because he knows intimately, he knows he has a positive expectancy. The only way he's going to fail is if he doesn't place the next trade. That's the difference. My accountant told me I lost 4% last year. That's all right, because I'm up 52% since February this year. So, swings and roundabouts. I'm happy to take a losing year. 4%, no worries. Next trade, please. And that's the difference. I'm just happy to wake up and go, let's put another trade on today and see what happens. And this is Bill Dunn, and he's noted for his, I just ride the bucking bronco, I think is what he says, isn't it? I just get on that horse and go for it. He doesn't care about risk-adjusted returns. All he cares about is his positive expectancy that he knows, intimately knows, he can create by following trends. And that's what he does. Any questions? Interesting equity curve in this kind of thing, right? Another analogy we could use, Dennis, you can answer this question, seeing you sat up in front and gave me grief. Investment manager A returns 40% per annum. Investment manager B returns 40% per annum. Which one would you invest in? You'd be happy with both of those, 40% per annum? Mm-hmm. What if you knew that manager B made all his money in December? Oh no. Hold on, you just told me you were happy with 40% return. So what you're not happy with is how you got there. Right. That's the thing, right? This is one of the qualitative traits that differentiate a successful trader to someone who's struggling. The journey being travelled, okay? We all want to be an Eckhart. We all want a 25% annualised return. But buggered if we actually want to go through the pain to get there. And Bill Dunn, I mean, that's just wild. He's at new equity highs now, I think. Yeah, I think he is.
That's like 6 years going flat on down.
Sorry?
The last 6 years.
Yeah.
From nowhere.
And he kept going. There's new equity highs now. That's big balls, you know. I mean, you know, people get annoyed after 3 weeks. 6 years, hello, you're an idiot. Except for the buy and holders. It'll come back, it'll come back. It will. Where am I? Okay. We're just going to finish up a little bit earlier here, unless we've got questions. Your equity curve can't rise every day. Okay? It just doesn't go up linear. It's a fact of life. Flat periods, down periods, bad periods, they're going to happen. It's a fact of life. You have to be able to get through that stuff. It's like another analogy I use about driving from Melbourne to Sydney. I don't know how long it takes. What does it take, 12 hours? You're going to need a rest break. You're going to need to go to the bathroom. You're going to need to get some lunch or dinner. You might get tired, and if you do what they tell us, you'll pull over and have a rest. Chances are, as soon as you get in New South Wales, there's going to be roadworks. So you're going to have to take a detour. My point is, you know this stuff, right? You know this, you are prepared for it, and you go ahead and do it, and you hopefully arrive safely in Sydney. Correct? But when it comes to trading, we don't actually know what's going to happen. And that's what causes all the problems. So once you fully understand that what potentially can happen, you accept that, you can then execute it and facilitate it, and away you go. Okay? I've got some mates who run a big hedge fund, and you go to their office and blast it all around their office. I mean, these are guys who manage, you know, more than 7 figures. And they've got these little bloody yellow stickies everywhere. On the computers, on the door, when you walk out, on the bathroom. Next 1,000 trades. They're everywhere. Next 1,000 trades. Next 1,000 trades. And that's just to remind them, one trade just doesn't matter. It just doesn't matter. I bought GrainCorp the other day, and the bastards came out 2 days later and did a 9 for 10 equity raising. Like, ooh, you know, Things happen. If you trade long enough, things happen. People send me emails, oh, Nick, you got us into GrainCorp. Why didn't you know that? Well, I didn't know that was going to happen. They just happen, okay? But get over it and get on with it. Think of trading in terms of a process, not in terms of the monetary value. We place too much emphasis on money. That's the kind of society we are these days. Fast, want it now, don't want to do any work, and I want to make money. Enter Spruker. Okay? What I tell my subscribers, especially with the longer term trend following models that I run, is don't even look at your account equity. Don't look at it. Place the trade, walk away. Let it do what it's got to do. If you don't let it do what it's got to do, then you're not going to achieve what it's set out to achieve to. Simple as that. So think of trading as a process of, I know how to create a positive expectancy. Everyone knows how to do that, right? Okay, maybe not. Positive expectancy, very simple. Cut your losses, let your profits run. Simple. Just do it. Find something that works, validate it, do it. That's it. So think of trading in terms of a process of creating a positive expectancy. Forget your money, doesn't matter. Doesn't matter about the money. Right? That's just a byproduct of following the process properly. Remove yourself from the trading environment. Place your trades, turn your computer off, go away. Let it do what it's going to do. You can't control it. So there's no point watching it. I don't live in Noosa to watch the screen all day. Okay? Place your trades, close the computer, go fishing. That's it, right? That's what you've got to do. Remove yourself and just let it happen. And understand that sometimes it's not going to be fun, sometimes you're not going to make money, but over the longer term, you can't fail. You can't fail. Allow the account to flow rather than forcing it. Who does that? Go up! Go up! You go up! That's what Daryl does. I was watching his market minute. Where's Daryl? That's what you're doing, isn't it? Go up! Give me that market minute. Go up! You can't do that. Well, some people might be able to. But at the end of the day, just go with the flow. Let it happen. Understand over the long term, your positive expectancy will look after you. All you have to do in the short term is be there for it. Because if you're not there for it, it can't help you. Any questions? Yeah, John. Yeah. Easy question, please. Okay. Come up to the microphone. Now, you're not allowed to refute anything I said, okay?
Not at all, not at all. For starters, a brilliant presentation. Thank you very much. Hit on a lot of really, really good points. You showed some charts where there's some pretty precipitous drawdowns. And I'm curious, like one of the things we look at, you showed a lot of very technical analytical tools that allocators use when they make allocations to managers out there.
Yeah.
And within the systems you use, do you chart the drawdown versus like the maximum or the Sharpe ratios behind the systems you use to pay attention to figure out maybe which system is more suitable or which one is giving you more edge in the market? And looking at those drawdowns, like how much money you're making versus how much it comes back in your favor?
I used to when I ran a hedge fund and I was trying to be smart, but now just trade it.
Cool.
The best indicator is the value of my account.
Sure.
I'm tipping if it's going up, I'm doing okay. If it's going down, well, it must be a tough period. So, no, I don't, and I know you're a CTA and that's all very important. And when I was a CTA, that was all very important to me as well, but nah, too old for that, mate. I'm 42 now.
One other question as well. Looking at Eckhart's and Dunn's performance, it's interesting if we, just talking out loud, superimpose their charts on top of an S&P chart from the beginning of the bull market of 1974 and do a comparison in terms of what the S&P did from 74, rallying higher. I think the S&P was sat back at 80 or 100 or something, and then rallied up to 1,500 during that time.
Yeah.
But on a compounded basis, how that, just speaking out loud, how that sets up.
Well, there it is there, right? So that's your total return, 11.71 versus Dunn's 18.84.
Right.
Now that's a semi-log scale chart there.
Sure.
Okay, so...
Clearly outperforming, clearly picking up alpha. I guess the Sharpe ratio or the drawdowns within that regard get interesting.
Oh, absolutely. I mean, what John's talking about here is he's coming from a professional fund manager's perspective, which is what I've based my trading on all my life. It's not about absolute return, okay? Think of someone like Toby Crable. Toby Crable has an annualised return of 8-9%. Okay, you think, what a wanker. Why bother? The guy manages about $5 billion. Eckhart manages 450 million and he's got an annualised return of 25%. Why is this so? Because the big allocators, the big boys out there with all the money, no, they don't want to go to the casino, they don't want to ride a roller coaster, they want a low risk adjusted return. They want a supercharged cash management account. They're happy to have 10% annualised returns that's non-correlated to the stock market in their particular instance, with very small deviations from that. Whereas with Eckhart, you can see it's a bit more of a roller coaster. And Dunn, I mean, that's just crazy. So when you get into the big money, the big professional money management, it becomes more about risk-adjusted return. And that's the way I've been brought up. Specifically, I don't go for an absolute return. I'm not trying to make 200%. But if I can compound 40% a year and do it in less than 5 minutes a day, I'm pretty happy. And that's how long it takes. Because once you've got your system, and I use AmiBroker, you just push the button and away you go. Any more questions? Yeah. You want to come down here, Peter?
Nick, with that, the equity curve we've done there, two things that concern me is he started off with a 52% drawdown, which was within 7 years, and then also the 60% drawdown. I know you mentioned that was part of his his positive expectancy, but what sort of ratio did he have? Was it within his parameters or was it outside?
I don't honestly know, and I don't think he really cares. The way Dunn says, in fact, he's well known for this. If you invest with Dunn and you ask him one question, you're out. Serious. It's my way or the highway. And he just stands on his track record. He goes, that's it? You like it? Fine. Don't ask me any questions. You don't like it? Fine. Out the door. Serious. He doesn't beg or grovel for money. He's only got 5 clients, funnily enough. But it all comes down to attitude. He manages $5 billion, so I'm tipping the 5 clients are, well, you'd think they'd be smart, but maybe not. But that's what he puts out. Ride the bucking bronco. You're on the ride or you're off the ride.
Yeah, but, minus 52, it looks like you're going to be off the ride pretty soon.
Or is it new equity highs? Look, I agree. I mean, that's just a wild ride. But that's the way he does it. And he's not scared to get... I mean, I don't know how the guy sleeps at night, really. Fair income, but, everyone has a personal tolerance. Obviously, his is substantial. Personally, I know what my kind of maximum drawdown area is, where I have to say to Trish, I've stuffed up. It comes in around 40%. When I lose 40%, I kind of say to Trish, look, just give me a bit of space.
Go fishing, Nick. Time to go fishing, Nick, isn't that right?
Yeah, I used to have hair. Time to go fishing, yeah. Any more questions, anyone? No? Well, thank you very much. Lunchtime.
Thank you, Nick. That was an excellent presentation. And I think it was a really good final piece for this conference. We need to realise that we've been exposed to lots of different strategies and lots of different ways of trying things. It doesn't mean we're going to be professional at them yet. We just need to practice them and remember the pieces that Nick put together today. Thank you very much indeed.
Thank you.
Fantastic. Cheers.